If I told you that one of the greatest investors of all time, Peter Lynch, thought that bonds were a terrible investment for most people, would you believe me? This is the same Peter Lynch who ran Magellan Fund at Fidelity and delivered a 29% annual return for 13 straight years, turning $10,000 into $280,000. In his classic book, Beating the Street, Lynch didn't just teach how to find great stocks. He also made a powerful case against investing in bonds. So today, we're diving into why Peter Lynch believed bonds were riskier than they look, why he thought stocks are safer in the long run, and how his logic still applies, even in today's world of higher interest rates and inflation. Stick around to the end, and I'll share with you how I personally think about bonds in a long-term compounding portfolio. Hello, fellow compounders. I'm Dennis Chen, CFA charter holder, Wharton MBA, former hedge fund manager, and chief compounder here at the Always Be Compounding Club. This channel is all about how to invest smarter, build wealth that lasts, and achieve financial independence, one compounding decision at a time. If you find this helpful, make sure you hit like, subscribe, and turn on notifications so you don't miss future videos. And remember, before we dive in, a quick but important disclaimer. This video is for educational and entertainment purposes only. It is not financial, investment, or tax advice. All takers and examples are hypothetical and for illustration only. I'm sharing general information and examples, not recommendations tailored to you. Investing involves risk, including possible loss of principal. Past performance does not guarantee future results. Your situation is unique. Always do your own research and consult a qualified financial professional before making any decisions. All right, let's dive in. Segment 1, the safe investment that isn't. When most people think of bonds, they think safe or safety. You lend money to a government or corporation. They pay you interest, and at maturity, you get your money back. But Peter Lynch said, gentlemen who prefer bonds don't know what they're missing. His point? Bonds might look safe on the surface, but they carry a hidden danger that slowly eats away at your wealth. Inflation. Let's say you buy a 10-year bond paying 4% interest per year. If inflation averages 3% a year, your real return after inflation is just 1%, and that's before taxes. If you're in a 25% tax bracket, that 4% coupon is really 3% after tax. Subtract that from inflation, and you're basically running in place, or even falling behind. Lynch called that the illusion of safety. You feel secure because your principal is guaranteed, but in real purchasing power, it's shrinking every year. He liked to joke, if you want to guarantee yourself a lifetime of mediocre returns, buy a bond and hold it forever. Segment 2, stocks beats bonds over time. In his book, Beating the Street, Lynch showed decades of data proving that stocks consistently outperform bonds over the long term. Imagine you invested $100,000 in long-term government bonds 30 years ago. You'd probably have around $300,000 today. But that same $100,000 in a broad market stock index like the S&P 500 would be worth more than $1.2 million right now. That's the power of ownership versus lending. When you buy a bond, you're a lender. You cap your upside at the interest rate. But when you buy a stock, you're an owner. Your upside grows as the company grows. Lynch believed ownership, not lending, was the path to building real wealth. And history has proven him right. Since 1928, US stocks have delivered about 10% per year, while long-term bonds averaged around 5%. That 5% point gap may not sound huge, but compounded over 30 years, it's the difference between tripling your money and multiplying it by 17-fold. That's the essence of what I call compounding asymmetry. Small differences in returns become massive over decades. And that's why Lynch said most investors are better off owning productive assets, not IOUs. Segment 3, the hidden risk of bonds. Now here's the irony. Lynch said bonds aren't just low return. They can also be high risk under wrong conditions. How? Through interest rate risk. If you buy a 10-year bond at say 3% and then interest rates rise to 5%, your bond's price drops. You can only sell it at a discount because no one wants to buy your low yield bond when they can get 5% elsewhere. Lynch warned that this risk is especially dangerous for bond funds because bond funds don't mature. They keep rolling over bonds, which means when interest rates rise, your fund's value can fall. And you have no maturity date to get your principal back. As he put it, a bond fund offers no protection against higher interest rates, which is by far the greatest danger in owning a long-term IOU. That's exactly what happened in 2022, when the US bond market had its worst year in decades, down over 13%. So much for safe. Segment 4, the opportunity cost. Every dollar you lock into a 10-year bond paying 4% is a dollar that can't compound at 8, 10, or 12% in equities. He argued that while bonds may feel emotionally comforting, the real risk is failing to grow your wealth fast enough to meet your goals. That's especially true for younger or mid-career investors, people who have decades ahead of them. In his view, putting too much in bonds is like driving with one foot on the brake. He said it bluntly, you can't become a millionaire clipping coupons. Segment 5, the one-time bonds make sense. Now Lynch wasn't completely anti-bond. He gave one interesting rule of thumb. When the yield on the long-term government bonds exceed the dividend yield of the S&P 500 by 6 percentage points or more, sell your stocks and buy bonds. That's a rare situation when bonds are so cheap and yields so high that they actually offer a better risk-adjusted return. In other words, he wasn't dogmatic. He just believed that most of the time, stocks are a better bet, especially when inflation and interest rates are moderate. Segment 6, ownership beats lending. Let's zoom out for a second. What Lynch was really saying wasn't just avoid bonds. He was reminding us that ownership beats lending, almost always. When you lend money to a government or a corporation, you're capped. You get your interest and you get your principal, and that's it. But when you own a great business like Apple, Netflix, or whatever good business you can think of, Starbucks, one that's growing earnings, reinvesting profits, and raising dividends, your upside is unlimited. That's why Lynch loved companies with consistent growth, low debt, and understandable products. He believed that the best inflation hedge wasn't gold or bonds. It was a portfolio of profitable, growing businesses. Because businesses can adapt to inflation. They can raise prices, improve efficiency, and keep compounding value. Bonds can't do that. Segment 7, how this applies today. So what about now in 2025 when the 10-year treasury yields are around 4.5% to 5%? Does that mean that Lynch would suddenly love bonds? Probably not. Yes, yields are higher than they were in the zero interest rate decade, but inflation, taxes, and opportunity costs still make it a tough case. If you earn 5% on a bond and inflation runs at 3%, your real return is 2%. After taxes, maybe 1.5%. Meanwhile, stocks still have the potential to deliver between 7 and 9% long term, and dividends that grow over time. That's why, in my own framework, I see bonds as a volatility buffer, not a growth engine. They have a role in smoothing out returns and covering short-term cash needs, but they are not what builds wealth. For long-term compounders, the engine of growth remains the same: equities, reinvested dividends, and time. Segment 8, coffee with the chief compounder. By the way, if you enjoy these deep dives into investing wisdom, come join me for Coffee with the Chief Compounder. It's a free live Q&A inside the Always Be Compounding Club community, where we talk about real investing challenges, portfolio, and how to apply these timeless principles. Your first coffee's on me. Just use the code ONEFREECOFFEE at the checkout. You'll find the link in the description below. Segment 9, the takeaway. Here's the bottom line. Peter Lynch didn't hate bonds because they were bad. He just understood what they really are: a tool for stability, not wealth creation. If your goal is to preserve purchasing power, build financial independence, and let compounding do the heavy lifting, stocks remain your best ally. Bonds can help you sleep at night, but stocks will help you retire right. Or as Lynch might say, gentlemen who prefer bonds don't know what they're missing. If you found this helpful, give this video a thumbs up. It really helps the channel grow. And if you haven't yet, hit subscribe and join our community of investors who believe that the key to building wealth is simple: always be compounding. I'm Dennis Chen. Thanks for watching, and I'll see you in the next video. Take care.